All right, good evening. Welcome to week one, our session, our multifamily masterclass. This is going to be everything that my wife and I have learned over the last 3 years. We're going to distill all that information down and make it relevant to people that are passive investors, because I think passive investing is the greatest thing in real estate. And I'm going to go into why. My wife and I put our money where our mouth is. We're actually in more passive deals right now than we are active deals. We're doing active deals. We're building our real estate portfolio. I love doing active deals, but we have more passive deals than active. And we're going to go into why. And our goal about 10 years from now is to be passive on everything. To me, that is complete, total financial freedom. So that's my exit plan. And we'll go into basically what we're doing and what our plans are and how we've planned our life. I'm going to share my screen here and go right into the presentation. If you have questions as we move forward, put them in the Q&A. And at the end, I will answer everyone's questions, I promise. So I'm going to share my screen here real quick. Hold on, let me get to the documents here. All right, we're having problems here with the thing. Just give me a moment here. I'm going to get this open and put it in PowerPoint mode. Okay, everyone should be able to see my screen now. Thanks for bearing with me. That didn't work quite the way I had planned. This is the first week, so let's go right into our presentation. Tonight, this is going to focus on why. So if you're a person that's looking for great tips on being a better investor, and you're looking at underwriting and you're looking at learning all the trade and all the tips and all of the metrics and all the different definitions, we're going to get into all that. But we want to start for a very simple perspective, because there's people on this call that have never invested in real estate before. And if you're an experienced investor, even an active investor, an active syndicator, it's really important to go back and look at your why and look at why are you doing this? Why are you doing the investing, and what's your goals and what are you going to accomplish when you achieve those goals? So the why is the most important thing. There's a famous saying that if you have a great why, then anyhow is possible. And I really believe that. So quick disclaimer, this presentation is for educational purposes only. We are not giving people legal, tax, financial, or any other type of advice. If you're going to invest, you need to consult your own financial, tax, legal, and other professional advisors to determine if investments are suitable for your situation. This presentation and documents include confidential information. It's not to be shared except by the owner or with their permissions. Anyone on this call tonight, I'm giving my permission. Please share this and spread it anywhere. All investments have risk. Make sure you understand the risk profile before investing. And anyone viewing this presentation or document should complete their own due diligence based on their own interest. I'm not guaranteeing investment results or outcomes related to real estate investing. And this document contains information from sources that are believed to be reliable, but we can't guarantee their veracity or their continued veracity. Anything that's a financial projection is based on what we believe to be reasonable, but they're based on assumptions, hypotheticals, and estimates. And nothing in this document's been reviewed or approved by the Securities Exchange Commission. When we raise money for deals and do syndications, we are under the auspices and we have to follow the laws of the SEC. And we'll talk a lot about that as we move forward, but nothing has been reviewed here by the SEC. And this is not a solicitation to sell securities, just to make that clear. Okay, so 3 key questions. We're going to focus on the why, and this is basically the most important thing. And everyone has a different why, so I want you to start thinking about what your why is. So the 3 key questions we're going to answer tonight are, first of all, why invest in real estate? Okay. Second of all, why invest passively in multifamily? And I think everybody should be a passive investor, basically in multifamily. And then why is now one of the best opportunities in history? And I really believe that. We're going to give some data and go into that. Okay, so a little bit about me. And this is obviously a very old picture, about 15 years ago. when I got started out. I've been in real estate about 20 years. I originally started transactionally as a mortgage broker and a real estate broker. Started out in 2003, so I've been at it full-time more than 20 years. I had a very traditional financial education. When I made money off my real estate transactions, my mortgages, my real estate, I was investing them in stocks. I was putting money in a savings account. I had a very traditional view of how to invest money. I didn't invest in real estate until the last couple of years, except for a home. I became self-employed basically in 2008 after doing about 5 years in the trade as a mortgage broker. 2008 was a very interesting time to start a business and to be a mortgage person when the whole mortgage industry was falling apart. But I came out of that really strong, and there's a lot of takeaways that apply to the current situation in real estate. And we'll talk about that in a future slide. Became a real estate broker in 2009. So I've been a full-time real estate professional in single family for 20 years, although I never bought any single families as investments. And in future slides, we're going to talk about why and see if this applies to you. This is my wife, Stacey Abella. This is a picture when she graduated as her MBA. She is even prettier now. You'll see that in future times that she's featured her on this call. She came from a very traditional background also, and that's one thing we had in common when we met. She came from a traditional, well-educated family. Her father has a doctor's degree. Her brother has a doctor's degree. She got an MBA, got an oil and gas. That's what brought her to Houston. She was a corporate finance executive. She had all the benefits, the 401k, the pension, had IRAs, had all the traditional investments. And when she moved to Houston, she met me. And basically, we started our life together and basically got married in 2008. This picture, for those of you who are wondering, is not photoshopped. The rainbow is real. There's nothing been touched on this picture. Basically, we had a storm before our wedding. And then right when the wedding was commencing, basically, the service finished, we were out on Galveston Bay. We had our wedding in Kemah, and a rainbow came out. And so we kind of felt that something was really special was going to happen with our future. And it was a pretty amazing thing. So we got together in 2008, started building a future together. We got married that summer. About 3 months after we got married, the whole world changed because the financial crisis, the great financial crisis happened. And basically, there was a lot of turmoil in the financial worlds. What happened to us, we weren't really affected by it. Her job was very secure. My mortgage company was very shaky when I first started it because of all the problems that were happening, but I navigated through those. And then what happened is everybody quit the business in 2009 and 10. So we started doing very, very well. But we were basically newlyweds with this amazing bond that we had. We were doing well. We were both successful. We were dreaming big. We were traveling all around the world, going on crazy adventure vacations, which was amazing. When we first got married, slowed down a little bit when we got kids. We were saving for the future through all the traditional things. My wife had a 401k with a match. She had a pension plan that the company set up for her. I was maxing out 401ks, maxing out IRAs. When we started having children, we were doing college savings funds, 529s, very, very traditional, very, very garden variety type of investments that financial planners tell you to do. We followed that traditional route until 2020. And three things happened that really shook us to the core. And this is the main reason I'm sharing our story, because if you're watching this and you're new in real estate, or if you've been in real estate a few years, you might really be able to relate to this. And this is going to tell you about our why and how we got to where we're at today. So first thing was the pandemic. And during the pandemic, the main thing financially that was really hard for us was that we had a lot of money in the stock market, a lot of money. And in March of 2020, we were on a ski trip. The pandemic hit. We had to come back to Houston. Or the last day that we skied was the last day that the slopes were open in Colorado before they shut everything down. Our stock market accounts got cut in half for about 3 months. It did come back, but the swing was 50%. And this was something that was a black swan that came out of nowhere. There was no amount of watching the market or technical analysis or anything that would indicate the stock market was overvalued. This was the ultimate type of black swan. So we saw the market get cut in half. It definitely panicked me because I was like, well, we've got time for this to recover. But what if this happened 10 or 15 years from now when we were trying to retire? What would happen? So I lost faith in a lot of those traditional investments. We were going along, and my wife had decided around the summer to the end of 2021 that she had been with her oil and gas company for 17 years. And coming off the pandemic, she had spent a lot of time at home with our son, who has autism. And we were making great strides in working with him and his development. And so she decided this is probably going to be something where I'm going to want to stay at home, spend more time with my son, spend more time with family. And she was kind of done with the corporate world at that point. At that point, we had plenty of savings. My mortgage company was killing it. It was great for my mortgage company because the interest rates went way down. I had a ton of business, and there weren't enough people to even handle the business. That's how good it was. So I did real well as far as my income. I took the big hit on the stock market. My wife had left her job. I was going to support the family of my mortgage company, which it was going to be no problem. And then in early 2022, something else happened to us that changed our whole lives. And this is in January of 2022, I got diagnosed with cancer. So we were on another family trip. We were in New Mexico. This is actually a photograph from the trip of us riding horses in the snow. And we're doing skiing. If you look at me closely and look at my neck, you'll see it's really, really, really swollen. I had very, very swollen lymph nodes, and it became very prominent on this trip. And I knew I had to get back to Houston, get in a doctor's office and find out what happened. So I went in just a couple of days after my 55th birthday, got diagnosed with leukemia. I was supposed to be the one that was here going to be taking care of the family and making the money. And I had to go in and do chemotherapy. I had to do a chemo port, and I had to take about 4 months off because I was not ready to like basically work during that time. I wanted to focus on my health, and I wasn't sure if I was going to be able to perform my business and take care of my clients. So I had to take 4 months off. During that time, we basically didn't have an income. My wife was working on a book that she wrote that became a bestseller, but at that time she was working, putting that together. And at the same time, she was also developing her coaching business that she was going to implement that year. So what I learned about these type of situations is when you have a health situation that affects your family, it always happens at the worst time. And this was probably one of the worst times this could have happened. So thank goodness I caught everything early. I did my treatment. I went through. I'm healthy now. Kind of a different person. It kind of changed my whole life. And it's been an amazing thing for me that really helped me get to where I'm at now and change my mindset. At the time, it was horrible. And, when you go through that and you have to develop a lot of gratitude, you're in the chemo ward and you realize you're the healthiest person in the chemo ward, and you're thanking God that you're the healthiest person in the chemo ward. So thank goodness, healthy now and moving forward. But this was a huge disruption. We didn't have cash flow. We didn't have a secondary income. And we started taking the top off the IRAs and the 401ks and going through our emergency fund. This was not in the plan. And when that starts happening, when you retire, if you've followed a traditional route, I can guarantee you it's panic city, because for 4 months, I was basically retired. So got healthy, got back to work, was starting to feel good. Next thing that happened, 2022, inflation skyrockets. Okay. This hit everybody. This is an equal opportunity wealth destroyer, except for real estate. So what happened to us was basically the inflation takes off, stock market gets crunched, bond market is getting crunched. There was one thing that didn't get crunched, and that was our home. We had bought a home in 2020, did a minimal down payment, and our home went up 60%, 60%, between 2020 and the current day. So I was seeing amazing stuff on real estate. And so I started talking to my wife and saying, hey, we got to do something here with real estate. We got to get involved in real estate because this is something that's an inflation hedge. And if inflation's here to stay, and nobody knows if it is or not. We've got to do something to combat that. So we went through these three things in 2 years. We had a totally different mindset, and we started searching for answers. And I don't want to sound like Morpheus from the Matrix, but if you're on this call or if you're trying to get in real estate investing, you probably realize that something is wrong. Something's wrong with the financial system, and what you've been taught your whole life doesn't work anymore. We're going to the mindset on that in a later week, but basically, our parents taught us to perform and operate in a system that no longer exists because we're no longer on a stable financial path with the amount of debt the government has and being off the gold standard. So we were all brought up on something that really doesn't work anymore. And it just took these three things to figure out basically that it wasn't working for us. So moral of the story, basically traditional time for money, which is what my wife was doing, going to the corporate world. And me, I had to work basically to make money. If you're processing mortgages or going out and showing homes in real estate, you're trading time for money still. And the traditional investments weren't working because when COVID happened, there was no answer for that in the stock market. There was no way to handle that. Black swans and inflation, they were compromising our saving strategy. And they were showing me that what we were doing was not going to work anymore. And it had gotten us to a certain level. But what I'm telling people now is that system, that operating system will get you to a certain level. But once you get to that level, it won't take you to another level. So we had to find that out the hard way. We had black swans with COVID, inflation. We had all kinds of problems with me getting sick and then having the inflation on top of that. It was a very stressful time. We needed a new investment strategy to fuel our dreams. So I started looking at real estate, and I remembered this quote that I got from Andrew Carnegie. He was an amazing person, and I'm going to read it here real quick, and we'll talk about him for just a second. 90% of all millionaires become so through real estate. More money has been made in real estate than in all industrial investments combined. The wise young man or woman or wage earner today invests his money in real estate. Now, you can remember Andrew Carnegie was the wealthiest person in the world at that time. He founded U.S. Steel. He sold U.S. Steel for $300 million, which was a ton of money back then. That would be like, $500 billion now probably. And he gave away 90% of his money in the intervening years. And he founded a lot of libraries and founded colleges and did amazing things. He really did give back after he achieved his wealth. But he was telling people to invest in real estate. So that stuck with me, and I wanted to be a real estate investor. So let's talk about five reasons to invest in real estate. And let's talk about basically, these are my five best ones. There's a whole lot more than five. There's a ton of them. But these are my favorite, or these are why I invest in real estate or why I like it. So the number one reason is cash flow. Okay. And I put cash flow first for a reason. If you're a real estate investor, you need to invest for cash flow. You need to work on building your cash flow. Cash flow is what pays the bills. Okay. If you have appreciation in your home, so I'll give you an example, like on my home right now, it went up 60%. Okay. Can I pay my electrical bill with that? No, it's trapped equity that I can't touch. I can't do anything with it. Cash flow sets you free. Wealthy people, they invest for cash flow. And if you get in a deal with a lot of cash flow and something goes wrong and there's some issues, cash flow will save you in a deal. And so we're going to talk about investing in cash flowing deals. Robert Kiyosaki, I think, says it best. He says, I'm a cash flow guy. And he says, if it doesn't cash flow, just forget it. I'm not investing in it. So I really, really like that. So invest for cash flow, number one. Appreciation. So never invest in a deal because you think the value is going to go up. Okay. That's the icing on the cake. And appreciation is an inflation hedge. Properties tend to go up in value over the future, especially over long time frames. Donald Trump, our president, says never appreciate in a deal, never invest in a deal based on the fact you think the value is going to go up. And I think that's great advice, but appreciation is the icing on the cake. And if you're going to hold real estate for long times, over long time frames, it always goes up over a long period of time, even though there's bumps in the road as we go along. Okay, tax advantages. If you talk to an accountant, any accountant, I think they will 100% agree that there are more ways to avoid taxes in real estate, owning real estate, with real estate than any other investment. Just take your primary residence. You can deduct mortgage interest. You can deduct property taxes up to a certain limit. You can deduct a home office. There's so many deductions just with your home. And when you get into investment real estate, there's so many extras. There's depreciation. You can do 1031s. Imagine if you could do a 1031 on the stock market. Like you could buy Apple and do a 10x, and then you could trade it over to Nvidia, and it would basically pay no taxes, or go buy a Tesla or whatever and pay no taxes. You can't do that in the stock market. The real estate market's the only way that things like that are available. The government wants you to invest in real estate, and they will give you advantages to basically encourage you to do so. Leverage. Leverage increases your returns, or you can use cash out basically to put money in your pocket tax-free. So let's talk about the first one, increasing returns. If you go out and pay cash for a property, let's say it's a $100,000 home. Okay, so you've got $100,000 in the deal, it's all cash. And the property goes up 20%, $20,000. Okay, you've made 20% in your money. It's not bad. But if you went to the bank and borrowed 80% and put 20% down, so you have $20,000 in the deal, and the bank carries the 80%, and then the same home goes up 20%, guess what? You just doubled your money because you have leverage. So I think everyone should use leverage in real estate. You should be prudent about it, but leverage is what makes you rich in real estate. It is something to be used with some caution. I tell people leverage is like fire. It can heat your home, it can cook your food, but it can also burn you. So it's got to be used with care, but it can increase your returns. The other way leverage can really help you, or debt can help you, is cash out refinances. So you can do a cash out refinance basically to give you the money back that you invested in the deal. So you get to a place of what we call infinite return when you have no money invested. Or you can also use that just to put money in your pocket after you've reached that infinite return. I know people that have multifamily, they go back every 5 to 7 years, do a refinance and pull out a ton of money. They do a little bit to improve the property, and they give it back to their investors or put it in their own pocket. So you can use real estate like an ATM machine, basically, with cash out refinances. And I love that strategy. The other thing is stability. Okay, it's a hard asset. It's diversified away from the stock and bond market. When you have a hard asset, you have insurance on the property, it limits your downside. Can real estate go down in value? Yeah, certainly it can. But the fact that it's something real limits the downside. I think everyone's heard of stocks that went down to nothing, like went bankrupt. Here in Houston, Enron comes to mind. It was a top 10 company in the United States. It was, I think, number 7 as far as market cap. Went to zero, went bankrupt, went out of business because they had fraud in the company that wasn't detected for years. With real estate, there's always basically a floor on how low it can go, because it gets cheap enough, people come in and buy it. With a stock, once it starts a free fall, who knows what's going to stop. So I love having hard assets and also diversifying away from your other assets. Okay, 5 reasons to invest in multifamily. Okay. And I think everyone should have multifamily as part of their portfolio. I'm not saying put all your money in multifamily. I think that'd be foolish. I'm not saying take all your money to the stock market and invest it in real estate. But these are my top 5 for multifamily. And this is why I like it. And this is why I invest. So the first is the impact, basically, that housing is an essential need. Okay. This is not something that can get disrupted by Amazon. It's something that can get disrupted by Google. There's not a lot of technology innovation as far as housing. You still got to build properties. You put roof over people's head. Multifamily in particular is very hard to build. Anyone that's a developer will tell you that. So it's an essential need, and it's difficult to build and difficult to replace. Because of that, it's a good thing to invest in because it's essential. During the pandemic, when people weren't going to work and they weren't driving around, remember freeways with no traffic, people had to pay their rent. And basically housing, it was still a necessity. Coming out of COVID, a lot of office space was closed down, not being used. We know when factories have left towns, basically there's been industrial space is not being used, but people have to have somewhere to live. Okay. Forced appreciation, which is what we look to do in multifamily. So the best way to understand this is to look at the NOI model versus comparable sales. So when you own single family investments, okay, the value of the home, the appreciation is based on a comparable sale model. That is basically what a realtor can sell a property for in your neighborhood. So if you have properties of a certain value, and then all of a sudden properties in your neighborhood start selling for a little bit less money, let's say 10%, the value is going to go down 10% in your area, in your neighborhood. It's based on sales the last 90 days. Done thousands of mortgages, looked at thousands of appraisals. This is the standard that everyone uses. You can be the best operator in the world as far as single family. You can cut expenses. You can raise rents to the top of the market. You can raise rents 20%. We'll provide more cash flow. It won't touch the value of the property. Now, in multifamily, with the NOI model, if you raise the NOI, which is the net operating income, we're going to go over what all these terms mean. It's basically your total income minus your total expenses. If you raise that 20%, all things being equal, not any major shifts in the market, the property value should go up 20%. So the way to think about that is if you had two apartment buildings that were 100 units and they're located on the same street, okay, and you had one down the street that was operating with a 20% higher NOI, identical property, it would be worth 20% more than the one that was the lower NOI. With single family, you can't say that. If you raise rents $100 a month, it doesn't change the value of your property. It puts more money in your pocket, but it doesn't change the value. So we do what we call forced appreciation in the multifamily model. High returns versus risk, okay? The returns are very, very good in real estate. They're very good in multifamily. Are there risk? 100%. The main thing that we're going to emphasize in this course is we're going to teach people how to not lose money. What I found is in real estate, there are very few singles. There are a whole bunch of doubles, a lot of triples, and a lot of home runs. So if you can cut out basically losing money, and if you can cut out basically having deals that go bad, you will do very, very well. Also, there's a very low correlation with stocks and bonds, okay? So basically, when the stock market dropped 50% during the pandemic, it really didn't affect multifamily at all, okay? This multifamily market is distressed right now. It's a good time to buy. We'll get into that. Well, the stock market's been doing pretty good. They're generally not correlated. The only time they were correlated that I'm aware of was the great financial crisis. And it's basically because everything was going wrong. Everything was going bad. So, but it's very rare there's a correlation. So it's a good way to diversify away from the traditional stock and bond model. Tax advantages. There's even more tax advantages on multifamily. Things like cost segregation and bonus depreciation are standard things. Now, you can do this on single family also, but most people don't. Cost segregation is coming in and getting an engineering study and dividing the property like a pizza into things that you can depreciate at different times. So they look at what's the carpet on the whole property worth. We'll depreciate that 5 years. The roof might be 10 years. Certain things are 15 years. But basically, we want to depreciate the property faster. And then we use bonus depreciation, which went down this year. But there's a good chance with the legislation, it's going to go back to 100%. We take all that up front. So in many cases, when you, let's say, invest $100,000, your K1 the first year will be a negative $50,000 to a passive investor, which you can use against your other passive investing. And the whole idea in real estate basically is to never pay taxes, okay? And I know a lot of people in real estate that are extremely successful, bringing in an amazing amount of cash flow, amazing amount of money, and they never pay taxes on it. Okay. So we want to get to a very low or no tax environment on these investments. Syndication, investing passively with professional operators is very easy. Can you invest passively in single family? You can. Those opportunities are a little bit harder to find, in my opinion, but you can. But investing passively with professional operators is very easy in multifamily. It's standard. The standard format is there. And I think it's the best way for most people to invest. I think everybody should do some passive investing, regardless of the other things that you're doing in real estate. Okay, single family rentals versus multifamily passive, because some of you are probably watching this and like, hey, I don't know, man, I bought a home that worked out great. I would have gone and start buying rentals. I think I want to go that route. This whole multifamily thing scares me, and I'm just not real comfortable with it yet. And there's nothing wrong with that. So what I'm going to present next, this is not a slight or not anything negative against people that have bought and operate single family rentals. I actually have a ton of respect for people that can do it and do it successfully. I think it takes a ton of courage. It's a ton of hard work. It's a ton of blood, sweat, and tears. It's very, very difficult. And I think most people can't do it. I think it's a little bit easier to learn to be a passive investor than it is to operate single families. So basically with rentals, most people that are doing rentals are the do-it-yourself types, okay? And if you're going to do it yourself, you're going to have to be a jack of all trades, okay? And this is how most people do it. And so what I mean by that is you're basically doing everything. And you've got to be competent at all these different skills. So the first thing is you got to go out and find a property. You got to work with an agent or work with a broker or work with an owner, somebody to go find a property. You've got to go sign the contract. You've got to go negotiate the due diligence and go through and do all your due diligence. You've got to sign a loan, which we'll talk about that in just a minute. You close. You've got to go do repairs. You've got to do the work yourself or hire people out to do it. And if you've never worked with contractors, that can be extremely difficult. Or you have to do it yourself. Okay, now you got to find a tenant if the property's fixed up and ready to go. You've got to collect rent. You've got to sign a lease. You got to make sure that you follow all the fair housing laws so you don't get sued for not following fair housing. You got to collect rent. If someone's late, you got to, basically get on them and basically be a property manager and get that rent collected. If they don't pay, you're going to have to evict them. If they move out, they may have trashed the property and you got to go over and clean it up, and you got to get contractors to come back and fix everything. And that's going to hurt your cash flow. That's very unpredictable. I mean, some tenants are wonderful, some are bad. It's really hard to figure out. So all the things I just mentioned, you've got to be really good at those things, or at least competent, because if you're bad in one area, like if you're not good with the construction, hire bad contractors, or if you're bad at collecting rent, or you're not firm enough with your tenants, you're going to have a lot of problems. So I have great respect for it. I think it's very, very difficult. And I don't think it's right for most people. And I encourage people that want to do this to get some help and partner with someone that's more experienced, get mentoring, because it's very difficult. Also, too, with single families, you're trading time for money. You have to spend time acquiring the properties, which in multifamily syndications, you don't spend any time doing that. You don't put any money at risk either during the acquisition. You've got to spend time managing the properties, okay? Dealing with issues, dealing with maintenance when a tenant calls you and there's a problem. Deal with trying to get people to pay on time. If there's an eviction, you got to hire an attorney and go to court. And you got to spend time repairing, basically, the property, either to get it ready to rent or to turn it, basically to get back and get it with a tenant again. So these things are very, very time consuming. And if you have a couple of them, it's not too bad. But if you're really trying to scale up and you're trying to operate 10 or more rentals, it gets very, very, very difficult. And it's something basically that I don't want to do. I'd heard a lot of horror stories when I was doing a lot of mortgages and doing a lot of real estate with people that had rentals, and it just kind of scared me. And I still think it's real hard to trade time for money in that. And people are going to call you at the worst times too, when you don't really want to work on these issues. Mortgage debt, who signs the loans? Okay. I am in 6 passive deals now, and I am in 3 active deals. And even on my active deals, I've never signed on a loan. We have a key principal that signs on the loan. And I can guarantee you, as a passive limited partner, you're never going to sign on a loan. So if you don't want to take on more debt, and the debt you take on with a single family is recourse debt. Okay. So you need to realize that if you don't pay, or if there's a foreclosure, they can come after you personally. We do non-recourse in multifamily, but that really doesn't matter because I've never signed on a loan. So you can invest in deals. You can put a lot of money in deals. You can invest millions of dollars and never sign on a loan. And if something doesn't happen on a loan, there's no recourse that can't come back and get you if you're an investor. So if you're really worried about going into debt, and it's very hard to make money in real estate without leverage, syndication might be good for you because you don't have to sign on the debt. As I said before, I'm going to emphasize this again: rentals are riskier for inexperienced operators. It is much, much, much riskier to do an inexperienced operator that's never done rentals before, never managed properties, never done repairs, never run a construction company, to do rentals. So I think putting your money with experienced operators that are professionals, that have a track record, is much safer. Don't want to scare people, but this is a really firm belief. A lot of people get into rentals and get in over their heads. And the people that are good at it and successful, I have so much respect for them, because I do think it's really, really difficult, and it's not something I want to do. Rentals, basically, to sum it up, you solve every problem, or your property manager does. But if you have a property manager, they're going to charge you for that. And basically, when there's any major emergencies or problems, they're going to call you, and you're going to have to get involved. So basically, when there's problems at the property, something happens, there's an accident, a crime, a fire, when insurance goes up and you got to renegotiate that, you just deal with every problem. You've got to sign on the loan. So think about that if you're looking at single family rentals. If you're operating them well and you love it, you want to continue to do it, that is awesome. So I have so much respect for you, but I do think that passive investing is a lot easier, especially for people that have basically they're professionals and they don't have time, basically. Okay. Why invest in multifamily now? Okay. So the market right now is distressed. I think everyone knows that. And it's on sale. So multifamily is down 30% or more. And the deals we did last year, 2 of them, basically, we bought for about 30% discount. And they were deals that were bought originally in 2022 and got in trouble with the wrong kind of debt. We'll talk about that later. I like buying things that are on sale, particularly when there's inflation. I was at a conference last year and I was going around asking people, what do you know in the whole world that is cheaper right now than it was 3 years ago? And I was kind of quizzing people, and people couldn't come up with anything. We only came up with 3 things. We came up with multifamily. Some people said office space. It took about 20 people to get to that. And it's like, yeah, office is really messed up right now. I don't know if I want to invest in that. And then someone told me big screen TVs. I don't watch TV, so I wasn't aware of that, but they told me that. So that's one thing that may be cheaper now. But if you think about it, there's a great value proposition, because everything has gone up 20 or 30% in value. Everything is at multifamily. So I think this is one of the best buying opportunities. And my wife and I did a whole bunch of deals last year and put a whole bunch of money at work in our own deals actively, and then also as a passive. And like I said, I have more passive investments than active. So I'm putting my money where my mouth is, basically, on passive investing. And when we get distributions after I invest and do no work, it is wonderful. I had some distributions that hit the account today, and it was like, this is so amazing, because I didn't have to work at all for it. There's a housing shortage, supply and demand. We're anywhere from 3 to 5 million short, based on houses. What happened is, going back to the financial crisis, for about 2 or 3 years, there was like no development. There was no single family construction. There was no apartment development. There was no money out there. There was nobody doing anything. So we got behind. We got an increasing population. People immigrated into the country. We have people having kids. The population is going up. We are short 3 to 5 million units, and we have not been able to catch up basically since then. And this shortage is probably going to get worse because right now there's not any multifamily development. 2 or 3 years from now, there's not going to be a lot coming online. And that's the very time there's going to be a lot more population, according to demographic studies. Okay. Buying a home is now unaffordable to most buyers. Okay. I know this all the time because I own a mortgage company. Okay. I get all the time, people are trying to qualify now for houses that they think they can afford and they can't because the interest rates are 6% or 7%. And they're running their numbers at 3 or 4% we had a few years ago, and it's unaffordable. I'm going to show you a chart here real quick, basically, that shows the record unaffordability. Okay. So this chart, the blue line is the average mortgage payment. And you can see this goes back to 2004. Okay. So it's going along. It goes down in 2011, 12 because housing prices went down, mortgage rates went down. It's pretty stable, going up a little bit, went down a little bit in 2020 because of interest rates. And then right around 2020 and 2021, it starts spiking upwards because housing prices took off. That's why we had that massive appreciation. And then interest rates took off. So right now, basically, the average price for a home is $2,432 a month as far as a mortgage payment for a median price house here in the United States. You can rent one for $1,781. And this is taking all markets. Obviously, there's some low-end markets if you think this is cheap. The spread between those two has never been bigger. So what does that mean? It means either rents are going to go up, basically housing prices are going to come down, or rates are going to come down. And if you look at what happened the last time rates went down, basically in 2020, what happened? The prices took off. So I think that's what's going to happen. I think rates will come down eventually, and I think housing prices will take off. If rates don't come down, what's going to happen is people are going to be kind of house trapped in their house with these great rates. They're not going to list their houses, and basically, I think affordable housing is kind of a thing of the past. And I think buying a house, it's going to be very, very difficult for a middle income person, a firefighter, and a teacher to put their incomes together and buy a home. Okay. Because of this spread, there's so many anomalies in the market because of COVID and all the money printing and all the inflation that might never come back. If housing is unaffordable, it's very good apartments. People are going to live in apartments longer. And I had an interesting conversation with somebody that was applying for a mortgage with me, basically a few years ago. And basically what they were saying was they wanted to go out and buy a house, and they lived in a wonderful apartment complex, a Class A. It had a swimming pool, a gym, a dog park, an amazing like resort style pool tables in the lobby where you could go play with your friends. And what he was telling me was, I'm renting and I want to buy a house, but even when I look at houses that are higher payment than what I'm renting for now, he said, if I move into this house, my lifestyle is going to go down. Okay. So basically, you get people that are under the age of 40. These people really prefer renting. Okay. They don't have the same type of thing that we had when we were growing up, when we were young adults, basically, that we were going to have buy a home. My wife and I, when we got married in 2008, the first thing we did was buy a house. A lot of people now can't afford a house. And people that are younger, they want to rent, they want to lease cars, they don't really want to own things. They want to rent apartments. And the apartments that they put in like the A class are so nice now that they don't really see buying a home as something that they want to do. They also got soured during the financial crisis. Maybe their parents weren't a home and it got foreclosed on. They got kicked out of their house and they moved into an apartment complex. they see a lot of downside. They think if they buy a home, they may lose money. And a lot of people can't come up with a down payment. So that's a trend we're seeing in people under the age of 40. And if you ask people about buying homes, they're not really big fans of it under the age of 40. There's exceptions to that, but that's a big trend. Okay, so final thoughts and what I want you to think about for next week. And I know we did a lot of our story and a lot of whys. So I want you to think about what your whys are, basically. So number one, what was your top takeaway from today's session? And you can put that in the Q&A, and we're going to have questions in just a minute. Hope people are putting questions in the Q&A. So think about one thing you got from this, because I gave you some good information, and I hope you had at least one good takeaway. And every time I do a real estate class, even if it seems basic to me, I always get something from it. So what's your number one takeaway from today's session? Number two, what is your why? Okay. Everyone has a different why. It may be because I want to make a better life for myself. It may be because I want to make a better life for my kids. If you're a little bit older, it may be I want to leave a legacy for my children. I want to leave something for them. And the legacy could be wealth. It could also be I want to learn skills as far as investing and pass that down to my kids. One thing I want to do with my children is teach them to be the world's greatest passive investors, where they don't have to make money decisions based on money. So think about what your why is, because in this business, that what will propel you. That's the most important thing. If you have a great why, the how doesn't matter. Okay. Also think about when you achieve your financial goals, what are you going to do then? What does your ideal life look like? So what would you do? Would you travel the world? Would you spend more time with your kids because you weren't working all the time? Would you spend more time involved in your church or involved in charities or doing things that you're passionate about? Would you go start a business? Maybe something you always want to do, or maybe you would engage in a hobby or something you enjoy. Maybe you take up more physical fitness and work out more. This is different for everyone, but think about achieving your financial goals. What are you going to do when you get there? And enjoy that process and that journey as you achieve them. The other negative on that would be, what does life look like if you don't achieve your goals? So don't want to be negative about that, but you need to be motivated possibly by the negative. Okay. My father grew up very, very poor. He had a very rough childhood with an alcoholic parent in the house. And it was a really rough life that he didn't really talk about very much. He was very poor. And he basically grew up, got out of town as quick as he could, joined the Marines. It changed his life, came out of that, decided he wanted to become an airline pilot, and worked very hard at becoming that airline pilot, achieving that goal. And he worked for an airline for 37 years and was an amazing success. And I asked him several times about that goal that he did of becoming a pilot and having a career in flying. And he said, well, it was very easy for me. He goes, my life was so bad in the beginning that I had this incredible motivation to not be a failure, to not be poor, to not do things. So sometimes the negative can be very, very strong. So think about your financial goals, achieving them, what you want to achieve, and then what you're going to do with it, because it's a lot more things about it that are important than being wealthy. Financial wealth is just one aspect of it. It's really getting your freedom back. And then what will life be like if you don't achieve those goals? And then also think about the kind of person you need to become, because one of the amazing things in my life has been how real estate has changed my life and I've become a better person. And I feel like I'm being the best person every day I can possibly be. And for years, I didn't think that.